gold traders spooked by all the tough talk coming out of the Fed, but I think gold now has a lot of support around 4,000 and is getting ready for another big rally. But when the dollar really starts to fall against other fiat currencies, global stagflation, particularly the Western economies, we've underinvested in capacity for all sorts of raw materials. And I think commodity prices are going to be headed a lot higher. We're also going to have higher interest rates, higher inflation, higher interest rates, more expensive commodities. Moving up by 25 basis points does nothing to change the dynamics. So the problem is we can't afford to pay the rates that are as high as they need to be. That's why the Fed has been artificially suppressing them. But that has other adverse consequences that you're seeing with the rise of the cost of living, which is being pushed up. And about how now there's a new sheriff in town and he's going to be real tough on inflation, unlike his predecessors. That's all BS. That's just this talk. He's trying to buy some cheap credibility on inflation by just talking about how tough he's going to be. And, for a lot of countries, ultimately, this is going to be a very good thing. It's long overdue. But the initial reaction, people are going to panic when this happens.
And this is also like one of the topics that's been emerging now, especially last week, about, for example, China building more and more gold reserves. There's all kinds of speculation about how much gold China really owns, and there's different commentators that have different versions of it. Some say up to 30,000 tons, and they are trying to prepare for what you just described now by at least linking gold to their own currencies, in this case the yuan for China.
I think China probably has a lot more gold than they let on, and they probably want to buy a lot more gold than they let on. And they're doing that for a reason. They understand that the dollar's days are numbered, and they want to position themselves to basically take that position. They want to have the dominant economy. They want to have the dominant currency. And the way to do that is to have the most gold, to have a currency that's backed by something, because that would be a viable alternative to the dollar, because the dollar is backed by nothing. So if, the dollar used to be defined as a weight of gold. Now it's just, paper. But our economy doesn't support the dollar's valuation because of our lack of productivity. But China's does. China has all the savings and production that we used to have.
Markets trust paper promises, yet central banks keep accumulating hard assets instead. Peter Schiff notes that speculation over China's gold reserves reflects more than curiosity. It highlights how nations may be preparing for a different monetary landscape. Whether reserve estimates are accurate or not, institutional behavior deserves more attention than official statements. Investors focused only on short-term volatility could overlook longer-term shifts in reserve strategy. Next, Peter Schiff exposes why new gold infrastructure could matter more than headline reserve totals.
And in this new, let's say, impulse of what China is doing in terms of building an infrastructure around gold, and we're talking about SGE vaults now that are in Shanghai, in Saudi Arabia, and others, maybe planned in Switzerland and other countries, of the convertibility between gold and yuan, and perhaps even commodities. We've seen also with in Iran, like the talk of like having Saudi oil paid in gold yuan. Do you see this as a viable infrastructure then to build and rebuild, let's say, the rails of international trade?
Sure, around China. I mean, look, China is a key factor. I mean, they're a major producer. They're a major creditor. They're the second largest creditor nation in the world behind Germany. They'll soon be the number one creditor nation. They're the largest manufacturers. So the Chinese economy is going to dominate, the 21st century. I mean, America dominated the 20th century, but we won't dominate the 21st.
And you just said also that you see oil going much higher. How much higher, and what would be the main catalyst, a part of the obvious situation that we see in the Gulf with the war in Iran? What's your full analysis around that?
Well, I think demand for energy is going to continue to rise, not just because of AI, but just for other factors in the economy. But I think the real catalyst would be if we get a breakdown in the US dollar, which we haven't had yet.
Infrastructure often changes markets long before prices reveal what's happening. According to Peter Schiff, expanding settlement systems tied to gold and alternative currencies reflects preparation rather than reaction. Even if adoption remains gradual, institutions typically build financial plumbing before capital flows accelerate. For investors protecting purchasing power, watching payment networks may prove more valuable than reacting to daily commodity headlines. Next, Peter Schiff reveals the hidden trigger that could connect dollar weakness with the next major commodity cycle.
It's something I've been expecting, but it's something that hasn't happened. But I think when the US dollar really starts to fall, and I'm talking about versus other fiat currencies, not, in terms of gold, where the dollar has already broken down, although it's bounced from its lows earlier this year. But I think gold now has a lot of support around 4,000 and is getting ready for another big rally. But when the dollar really starts to fall against other fiat currencies, that's really going to be a catalyst for a much bigger rise in the dollar price of oil. Because as the dollar starts to fall, if oil prices stay the same, that amounts to a decline in oil prices for everybody else. But I think the world will respond to lower prices by buying more, and that will push up the price in dollars.
And what about then other commodities? Because we've just talked about oil, but there's all kinds of other commodities that are impacted about the choke point in supply. Do you also believe that, Jim, we and I talked about this a few days ago, that this will be the onset of a global economic slowdown with a huge rise in inflation that we haven't seen since the 70s, a resurgence of the previous wave we just witnessed a few years ago?
Yeah, I mean, I do believe that global stagflation, particularly maybe in the developed the Western economies, is going to be what defines the next several years. I think we've underinvested in capacity for all sorts of raw materials, and I think commodity prices are going to be headed a lot higher.
Gold can rise for years before the dollar finally cracks against other paper currencies. What Peter Schiff is highlighting is the currency weakness can reshape commodity pricing long before most portfolios adjust. If supply remains constrained while demand expands, inflation pressures may outlast market expectations instead of fading. Savers relying solely on cash could discover purchasing power disappears faster than account balances suggest. Next, Peter Schiff unravels why higher inflation may collide with slowing economic growth simultaneously.
Along with overall inflation, based on all the money that's been created by the central banks, especially since COVID, but even going back to the days prior than COVID. But before COVID, after COVID, rather, they kicked it into a higher gear. So we have a lot of inflationary forces that have been built in that are going to be, rearing their head. And as well as increased demand and inadequate supply in a lot of commodities. So that's a recipe for much higher prices. We're also going to have higher interest rates, higher inflation, higher interest rates, more expensive commodities, and we could see recession and bear markets in stocks.
And that's actually a good segue to then what I've seen lately, saying that there's a big likeliness that the Fed will hike interest rates with 25 basis points by tomorrow. That those odds have risen above 35% for the first time after the inflation that data release. Do you believe this is really likely?
Well, I don't think they're going to hike rates. I guess it is a coin toss, but I think that they're still going to err on the side of staying pat. I think they have at least something to justify it based on. There's been some numbers that they can hide behind that might suggest that inflation may have slowed a bit or the economy is weakening a bit. But I think they're also likely to hide behind these task forces that they created to study the problems and come up with solutions.
The Fed talks about defeating inflation, while the structural drivers remain firmly in place. Peter Schiff's argument suggests markets may be focusing too heavily on one meeting instead of the broader inflation backdrop. Even if policymakers pause, accumulated monetary expansion and constrained supply do not simply disappear. Investors should separate policy headlines from long-term purchasing power risk. Next, Peter Schiff exposes why political timing may matter more than economic data in future rate decisions.
So they may be saying, look, we're waiting to get the results and the recommendations from the task forces. So that might, and if they don't move in this meeting, I think the odds that they move the next meeting are even lower, because now we're getting a lot closer to the election. And they don't want to take the chance of spooking the markets when the election's around the corner. So I think if the Fed is going to hike rates before the elections, they got to do it tomorrow. But I agree, if they do it, it's not going to be a big move. And I think, moving up by 25 basis points does nothing to change the dynamic. So if the Fed thinks rates are too low, a quarter-point rate hike's not going to do anything about it.
Well, it's a bit of a tit for tat as well in terms of the bond market and the fact that they aren't able to also really finance all those interest rates on the debt, right? I mean, the next 12 months, around $8 trillion of treasuries need to be rolled. The average coupon is around 3.3%. The 2 years around 4.3%. So that's a huge debt load, and just an interest payment alone as well. The question is, can they even hike rates?
Well, yeah, every time they hike rates, they do make it more difficult for the U.S. government, which has been rolling over more and more of their debt short term. So they're not even, borrowing for 10 years or 30 years. They're borrowing, for a year or less.
A quarter-point rate move grabs headlines, but trillions in refinancing quietly determine the real story. This is where Peter Schiff's thesis shifts from inflation alone to the growing burden of servicing government debt. Small policy changes may look decisive while leaving the underlying fiscal challenge largely untouched. Long-term investors should watch refinancing pressures, not just Fed press conferences. Next, Peter Schiff reveals why debt rollover could eventually limit policymakers' room to maneuver.
But yes, it's going to make it more expensive if they just want to borrow for 90 days. They're going to pay higher rates. And it's already happening. I mean, if you look at the net interest expense annualized in June of the U.S. government, we spent $1.6 trillion on interest. That was the entire federal budget as late as like 1997. And now we're spending that much money just on interest, right? Forgetting about everything else.
But how much more do you think that they can raise interest? I mean, there must be a limit.
Well, there's obviously a limit to how much the market can bear, but rates should be a lot higher given how much debt we have and how much inflation we're gonna have. So rates are still much too low. They should be a lot higher. The problem is we can't afford to pay the rates that are as high as they need to be. That's why the Fed has been artificially suppressing them. But that has other adverse consequences that you're seeing with the rise of the cost of living, which is being pushed up, and other misallocations of resources that result from the artificial suppression of interest rates.
And now let's talk about gold, your favorite topic. We've had nearly, I think, $900 billion wiped out from gold and silver in just the last 36 hours. Gold is down 2.4%, raising roughly 680 billion. Silver down roughly 5.5%, which is wiping another 190 billion.
The biggest warning isn't falling gold prices, it's the soaring cost of financing government debt. Peter Schiff notes that interest expenses have reached levels once equal to an entire federal budget, changing the fiscal equation. Temporary moves in precious metals can distract investors from much larger structural pressures building underneath. Wealth preservation depends on recognizing long-term debt trends before markets fully price them. Next, Peter Schiff exposes why sharp corrections can strengthen, not weaken, the precious metals case.
And then, in this whole context, we still have a war in the Middle East, we have inflation fears, and market uncertainty rising. So how is gold behaving, and what are the mechanics behind, and how do you see this?
Yeah, well, you can't look at the loss of value of gold and silver without appreciating the big gain that preceded that loss. Even though gold is down again today, we're still above $4,000 an ounce. So up until a few months ago, that was a very high price. So the fact that gold is not 5,500, I think is a lot less significant than the fact that it's at 4,000. And the same thing with silver. Silver, yes, it's not 120, which is where it got, but it's 57 and change. So it broke out. I mean, for years and years, silver was trading around $20, and maybe it can get up to 30 and it would come down. So all of that overhead resistance has now been cleared out, and silver has positioned itself for another huge bull market, even if it's had a correction in the first breakout of that bull market. And I think right now, I think investors were a bit disappointed in the way gold reacted to the war. Again, ignoring the fact that gold went up before the war started. And part of that rally may have been the anticipation of the war. And so it was a buy the rumor, sell the fact. And now you've got gold traders spooked by all the tough talk coming out of the Fed.
Short-term price swings often generate panic precisely when long-term trends remain intact. According to Peter Schiff, focusing only on recent declines ignores the magnitude of the earlier breakout in both gold and silver. Markets frequently price expectations before geopolitical events become headlines, leaving late investors confused by the reaction. Disciplined portfolios benefit from understanding positioning rather than chasing daily volatility. Next, Peter Schiff reveals why tough Fed rhetoric may prove weaker than investors expect.
And about how now there's a new sheriff in town and he's going to be real tough on inflation, unlike his predecessors. That's all BS. That's just this talk. He's trying to buy some cheap credibility on inflation by just talking about how tough he's going to be. But, even when he was asked in the Senate, in the hearings the other week, what are you going to do about high inflation? How are you going to bring it down? He had 3 policies, and they all amounted to talking about it and doing nothing, because the Fed can't do anything but talk, and the markets will figure this out. And so gold prices are going to hit new record highs, if not this year, next year, and the same with silver probably. So I would just be buying the pullbacks.
And how do you see this as major factors that will contribute to this way up? And let's say, what would be your price target personally with a certain date in mind?
Well, I don't really have a target, because I don't think that gold or silver have ceilings, because I don't think the dollar has a floor. The dollar could lose all of its value, in which case gold and silver prices would be infinite when you priced them in something that was completely worthless. But I just have a price target of higher. I think that you'll need more and more dollars to buy the same quantity of gold or silver. And so to the extent that you don't want to spend or invest your dollars today.
Confidence speeches rarely protect purchasing power if policy outcomes fail to match the rhetoric. What Peter Schiff is highlighting is the difference between communication strategy and actual monetary constraints facing policymakers. Whether investors agree with that assessment or not, credibility ultimately depends on measurable results, not promises. Long-term savers should evaluate policy through inflation trends rather than headlines alone. Next, Peter Schiff unravels why price targets matter less than the future purchasing power of currencies.
You want to save to potentially invest or spend in the future, you should not hold dollars. You should hold gold or silver instead of dollars. And the same likely applies to a lot of other fiat currencies, like, you're in Europe. So, I would prefer gold and silver to the euro.
Obviously. And now, let's talk a bit more also about miners, because miners have also been, I would say, affected by all of that. And there's something in the equation that also increases the cost of output, and this is obviously energy. So how do you think that this, and this is a question from our audience, how do you think that this energy supply choke will affect the mining sector?
Well, I don't think it's going to have that big an impact. I mean, sure, energy prices are a major cost for the mining stocks. But, the mining stocks didn't get that much of a benefit from the big drop in oil prices relative to gold prices. So I think the fact that oil's backed up a bit is not going to be the primary driver. I think earnings of the gold mining companies are going to continue to be very strong. They're going to continue to beat estimates and grow. And I think the stocks are undervalued, even if the earnings are less than what they're likely to be if they end up spending more on energy. And I do think that eventually this short-term negative correlation that we've seen between gold and oil is going to break down. And I do think that eventually, if oil prices really start to move up, gold prices will move up along with oil, not down.
So you think that the ratio would actually be intact and both would move accordingly in the same direction?
Yeah, despite the way they've traded recently, I think the long-term trend would be that oil and gold move up together.
Mining costs attract attention, but revenue growth often determines long-term valuations. Peter Schiff's argument suggests investors may overestimate higher energy costs while underestimating the impact of stronger precious metals prices on miners' earnings. Commodity relationships rarely stay disconnected forever, particularly during broad inflationary cycles. Looking beyond quarterly volatility can reveal opportunities hidden by short-term sentiment.